Assalamu alaikum. Bismillahirrahmanirrahim. Rabbi zidni ilma. Let's start this session. First of all, I would like to welcome you all to the session, the live webinar on IAS 12 income taxes. First of all participants are requested to kindly acknowledge me whether I'm audible or not. Am I audible to everyone? Okay, great. So first of all, let me give you the idea of this session and the agenda of this session, what we are going to discuss in this session, and what will be our benchmark for this session. So in this session, the IS 12, the most important standard in regards with the practical life and with the respect to the paper point of view as well. In F7, the financial reporting, IS 12 considered to be the most important standard as like IFRS 9 and consolidation and different accounting standards. So this is very important standard, and in this standard we are going to review each and every area and the examinations, and with respect to the examination point of view, that how the examiner can test you in this standard. So in this standard we are having a very quick introduction of accounting, introduction of income taxes, and as well as we also discuss the questions which examiners have already tested in the exams. That is, this is the standard which is tested in the final account question as well. It means if you are attempting a final account question, it is obvious that there will be an adjustment for income taxes, that is IAS 12. So let's start with this standard, and definitely we'll start with the basics first of all. Just give me a minute so that I can settle. Okay, so let us start with the income taxes. That what is income taxes? As you all know that if we talk about the components of financial statement, we have 5 different components of financial statement. That is statement of profit and loss account, statement of financial position, cash flow statement, statement of changes in equity, and notes to the accounts. Out of all these 5 components of financial statement, we have a very main component, that is statement of profit, statement of profit and loss account. The statement of profit and loss account. In a statement of profit and loss account, that is income statement, we have different line items, that is sales revenue, cost of sales, distribution cost, admin cost, and likewise interest expense, that is the finance cost. And in the end, and the very last component is, that is income tax. That is, if we have a profit before tax, and after profit before tax, the last line item is, that is income taxes. Income tax, we deduct income tax from this profit before tax, and then finally we arrive at the net profit, or we can say that the profit after tax. Now the question is that income tax, how this income tax is calculated. This income tax is calculated according to IAS 12. IAS 12 gives you an idea. IAS 12 gives you rules and regulations that how to account for that income tax in your accounts, in your P&L. So income tax, that is IAS 12, income tax that is guided, that is completely guided by IAS 12, that how to account for that income tax. So once we are going to calculate the income tax, IAS 12 suggests that in order to calculate the income tax, there are 3 types of taxes you need to account for there. 3 types of taxes you need to account for there. It means whenever we are incorporating, whenever we are recording the income tax, it means we do calculate 3 types of taxes. That is, number 1, the current tax. Number 2, the prior period tax. And third one is the deferred tax. It means if you wanted to calculate the amount of income tax that should be reported in P&L, we have to calculate 3 different taxes, that is current tax, prior period tax, and this deferred tax. And once we have done it, it means we will arrive to the income tax amount or the income tax value. So the central idea and the crux of this standard is on your screen. That means in this standard, in this chapter, in this topic, in this IS, we are going to learn that how to calculate the current tax, how to calculate the prior period tax, and how to calculate the deferred tax. And it means in this standard we are going to calculate all of these taxes. And out of these three taxes, the most important, I would say, the most important tax or the most important part is deferred tax. And most of the time, if you ask anyone about IS 12, they will let you know, they will tell you that IS 12 is not income taxes, it's a deferred tax. It means most of the time, many publishers, many accountants, and even many auditors explain in IS 12 as deferred tax. They give the title to that standard as a deferred tax, as because majority of the treatments are suggested by IS 12, and the majority of the treatment guided by the IS 12 is regarding deferred tax. It means the extensive learning will be on deferred tax. So now start with what is current tax. What is current tax? For this, let's see what is current tax. Current tax is basically the tax which is calculated on the taxable profits. Tax which is calculated on a taxable profit, that is known as what? Current tax. Now the question arises, what is taxable profit? What is taxable profit? So there is a question, inshallah we'll answer this one as well. In the next slides, we'll definitely answer this one. Now, what is prior period tax? We are just looking at a definition. Examiner may ask you a definition regarding what is current tax, what is prior period tax. So you must be aware about it. What is prior period tax? The tax of a previous year. Tax of a previous year, but adjusted in a current year. How it could be possible? We'll inshallah discuss this one as well. And what is deferred tax? The tax calculated on temporary differences. So these are the definitions of current tax, prior period tax, and deferred tax. Current tax means the tax which is calculated on your current year taxable profit is called current tax. Okay, let's first of all understand what is taxable profit. So in order to understand the taxable profit, let's find out the two different profits. Profits could be divided into two categories, that is the accounting profit and the tax profit. Now, what is accounting profit? Accounting profit is the profit that is calculated or that is calculated on the basis of IFRS, that is International Financial Reporting Standard. Whenever we prepare our accounts, whenever we prepare the accounts of a company, we do follow IFRS. International Financial Reporting Standard. Let's say we followed IS 16 for the calculation of depreciation and revaluation. We followed IS 38 for the calculation of or the recognition of development costs, or IS 30, the intangible asset. It means whenever we are accounting, whenever we are performing, whenever we are preparing the final accounts, we do follow IFRS. It means the profit which is calculated based on the IFRS, based on the principles of IFRS, is known as what? Accounting profit. But on the other hand, on the contrary, whenever the profits are calculated based on the tax laws, the question arises either whether there are different tax laws for the calculation of profit. Yes, there are different rules and regulations that is defined by the tax authorities. And I just make you a disclaimer that these tax laws could be different in different legislation. For example, if some tax laws which are applicable in India, this might be possible that these tax laws are not applicable in Pakistan. So it means there are different tax laws, and on the basis of the tax laws, if you are calculating the profit, so that profit is known as what? Taxable profit. Now recall the previous slide. Now recall the previous slide, please. Recall the previous slide. What I said, tax calculated on taxable profit is called current tax. It means if you are calculating the accounting profit, we are not going to apply the tax percentage or the tax rate on that accounting profit. We'll calculate that percentage or the tax rate on the tax profit, or we can say that it's a taxable profit. So it means now you can evaluate, now you can observe the problem which may arise. You have calculated the accounting profit, but the tax is calculated on the taxable profit. So it means now there might be some differences. There might some adjustments, adjustments are required. So it means there is a problem. We are calculating the accounting profit, but tax is calculated on the taxable profit. So it means there is something wrong. So what's wrong? Let's have some differences. Let's have some differences. that what is the difference between the accounting and the tax profit? What is the difference between the accounting and the tax profit? What might be the possible differences, and what might be the possible differences that examiner may test you in your exams? So these are the maximum differences which can be tested in your exams. That is the accounting profit and the tax profit. Accounting profit, normally in accounting profit or in accounting, when we are preparing the income statement or the P&L, whatever the donations we have made during the year, either official or unofficial, whether to the registered NGOs or unregistered NGOs, when we have an outflow of cash, we do recognize as an expense. We do recognize that in the operating expenses, because there is an outflow of cash. Either we paid that amount to our labor, to the employees for charitable purposes, or to any unregistered firm. We definitely recognize that transaction in our books, and we recognize that payment as an expense. It means unofficial donations are allowed as an expense in accounting, in our income statement. But tax department, tax laws, tax authorities never allow you for this expenses. They will never consider that unregistered business or unregistered donations as an expense. They will never let you allow. They will never consider that amount as an expense. So it means unofficial donations are not allowed as an expense. They will never allow you, and they will never let you to consider that as an expense, because in their eyes it's not an expense unless you made a donation to the registered businesses or registered NGOs. Another difference that might arise between the accounting and the tax laws, number two, is fine and penalties are allowed as an expense. We do record fine and penalties. We do record fine and penalties in our P&L. For example, company made a fine, company paid the amount of fine or penalties for the year, $30,000. So company would definitely recognize as a penalty expense, debit and penalty payable credit or bank credit. But in tax laws, fine and penalties are not considered to be the expense, because it's not a very good thing that you have done. So it means while calculating the taxable profit, tax department will not allow you to recognize this as an expense, because it's not a good thing. So it means fine and penalties are not allowed as an expense. Income tax department will never let you to record it as an expense. Third difference that might be possible, that is in accounting. In accounting, while calculating the profit, we do follow IS 16, and in IS 16 we have been recommended by IS 16 that to follow a straight line method or the WDV method for the calculation of depreciation. So while calculating the profit, if you are calculating the depreciation, definitely you will be looking for the straight line method and WDV method. But for tax purposes, they don't have any specific method. They might allow you 50% allowance on the in the year you have asset, you have purchased asset. For example, I bought a machine. I bought a machine for $5 million, and government allowed me as to claim the expenses at 50% in the year one and 50% in the year two. There is no procedure. There is no specific method in tax laws. Government will give you a relaxation, the government will give you an allowance, government will give you a deduction, government will allow your deduction based on this nature of asset, based on the nature of asset. So it means different methods and policies may be adopted by the tax laws. So it means while we are calculating the accounting, we are using a systematic allocation method, that it might be a straight line or a WDV. But if I talk about the tax laws never use these kinds of methods. They give you a deduction, they will allow your deduction based on a random basis or whatever their laws suggest them. Okay, next difference that might be possible in your exam or in your paper, that is the provision for doubtful debt. We do recognize a provision that might be we won't be able to recover any amount. We won't be able to recover any amount from our customers. So what we do, we make a provision for doubtful debt, that is bad debt expense debit and provision for doubtful debt credit. But tax department never allow you for that kind of provision. They will allow you, but when the customer has actually gone bankrupt, when you just left that expectation, you just confirm that we won't be able to recover that amount. You will just, when you are just confirm that you will not be able to recover that amount from the customer, then tax department will allow you to write off that debt. It means provision is just allowed. Provision is disallowed in tax laws, yes, but write-off is allowed. Government will allow you, tax authorities will allow you to deduct that expense or to consider that expense once the customer is actually gone bankrupt. Okay, another difference that might be possible to be tested in your exam, and inshallah we will practice for this one as well. Development. Development cost capitalized and amortized over the period. As per IS 38, what we do whenever we have incurred a development expenditure or the development cost, what we do, we recognize the development cost or the development expenditure in the balance sheet as an intangible non-current asset. Further, we amortize that development cost over its useful life, over its definite useful life. We amortize that particular intangible or the development cost. But what usually tax law says, they say they always recommend, most of the time, majority of the, in the majority legislation, what they recommend, that in the year you have incurred the development cost will allow the deduction in the same period. What does it mean? It means tax laws never allow you to recognize the development cost into the balance sheet and then recognize it as an intangible asset and then amortize over the period of 5 years. No, they will never let you allow. They will never let you to allow to claim the amortization in the next period. They will give you the deduction allowed. They will allow you the deduction, but in the period in which they are paid. So it means development costs are development cost allowed as an expense in the year incurred or paid. In the period you have paid that expenditure, they will allow you the deduction. It means as per accounting records, we will claim for the deduction in the subsequent years, in the next 5 years, but the tax department will not allow you this treatment or this adjustment. But what the tax laws will do, they will give you or they will allow you a deduction in the period you have made the payment. So that is the difference between the accounting and the taxable profit. Another difference that might arise, that is a gain on revaluation as per IS 16. You have revalued the property, okay, and you have recorded a gain on revaluation in your OCI, okay, but the tax department says we will not recognize because that is the unrealized gain. You have not yet realized that gain. So when you are going to realize that gain, once you will dispose that asset. So tax department says that you have recorded a gain on revaluation, you are recognizing that gain, but tax laws will not recognize that gain. It will recognize, it will give you a recognition, but once the asset is disposed of, once the gain on revaluation is recognized or realized. So it means for the timing, there might be a difference between the taxable and the accounting profit for this adjustment. And last, that is the accrual system. Usually, I won't say this, but usually accounting follows the accrual system, but tax department usually, generally speaking, they follow the cash system. What does it mean? We record as an expense if it is accrued, if it is incurred, if it is arised. For example, salaries accrued. What does it mean? That we have taken the benefit from the employees, but we have not yet paid the amount. But accounting system suggests, IFRS suggests you that you must recognize that as an expense. That is expense, debit, and payable credit. Rather, you have paid it or not. Irrespective of that, the payment is made or not. So it means we recognize expenses and revenues on an accrual system basis. But usually, generally, this might be possible that in some circumstances, in some cases, tax department may allow you the accrual expenses and income to be recognized. But for generally speaking, tax department allow you for the expenses when it is paid. If there is an accrued expense, accrued salaries, tax department accounting, that means IFRS, will allow you to record it as an expense, but the tax department or the tax authorities will disallow you for this expense for this current year. They will allow you, but in the subsequent years, as when you will pay that amount of salaries to your employees. So these are the possible differences that might or that could be tested in your exams. You must be aware about it, that these might be the differences that arises while calculating the accounting and the tax profit. So it's now confirmed that once we are talking about the taxable and the accounting profit, is there any difference? Yes, there might be some differences. There might be some differences which we have discussed. That it means you are calculating the profit based on the IFRS, but tax laws, tax department, tax authorities will calculate the tax on a taxable profit rather than the accounting profit. So what adjustments are required? We have to convert that accounting profit into taxable profit. We have to convert that accounting profit into a taxable profit. For this, we might have to consider these adjustments. So now let's practice the question number 1. And first of all, let me recall you, we have 3 different types of taxes: current tax, prior tax, and deferred tax. First of all, in question 1, we are calculating, or we are practicing how to calculate the current tax. How to calculate the current tax. Then we'll try and we will practice for the prior period tax. And finally, we will work out on the deferred tax, that how to calculate the deferred tax. So let's start. Let's start with the calculation of a current tax. Let's see. We have a question, that is car shift traders and an accounting profit before of tax of $1 million. That is PBT. How below is a list of admissible and inadmissible deduction by tax department or under tax regime. Okay, inadmissible deductions, that is deductions not allowed by the tax department. Accounting depreciation $100,000, provision for doubtful debt $15,000. Admissible deductions, that is deductions allowed by the tax authorities, that is tax depreciation $150,000. And write-off trade receivables, that is $15,000. Write-off trade receivables, that is $5,000. Sorry, $5,000. That is the debt to be written off is $5,000. So these are the admissible and inadmissible expenses that is allowed by the tax authorities. Corporate rate is, that is tax rate is 30%. Calculate the taxable profit and the current tax. I repeat, the taxable profit and the current tax. Why? Because we know that in order to calculate the current tax, we need to calculate the taxable profit. The profit given in the question is basically the profit before tax, that is the accounting profit. That is the accounting profit, and we cannot apply the 30% to the accounting profit. We have to calculate the taxable profit. So let's calculate the taxable profit. First of all, let's post the accounting profit. Accounting profit is $1 million. Accounting profit is $1 million, and we have to make certain adjustments. Now, what are those adjustments? Number one, inadmissible deductions. It means that expenses you have already recorded in your accounts, but it is not allowed by the tax authorities. So we need to remove that. So we need to remove those expenses. How to remove that? How to remove these expenses? Accounting depreciation have already been deducted from the accounting profits. It means the profit is reduced. So in order to remove that depreciation, the amount of depreciation or the accounting depreciation, we need to add back the profit. So depreciation as per accounting. Depreciation as per accounting. So we need to add back the profit, and the amount of depreciation was 100,000. 100,000. Another, that is the provision for doubtful debt. Provision for doubtful debt has already been deducted from the accounting profit. That is bad debt expense, but this is disallowed by the tax authorities. So we need to remove. We need to remove the impact of provision for doubtful debt. Provision for doubtful debt, and the amount of provision for doubtful debt was 15,000. That is 15,000. So we'll add back that 15,000. Now the admissible expenses or the admissible deduction, that is a tax depreciation. As for accounting depreciation, it was $100,000, but for tax depreciation that is allowed by the tax authorities is $150,000. So tax depreciation is $150,000 that is allowed by the tax authorities. Okay, again, the second thing is write-off that is allowed by the tax authorities, that is $5,000. So write-off bad debt, that is $5,000 allowed by tax authorities. Okay, so these were the adjustments we have made it. Now we are arriving at the taxable profit. It means in accounting profit we made certain adjustment, and now we are arriving at the taxable profit. Now what is the taxable profit? Let's calculate the taxable profit, and that is 1 million plus 1,50,000 minus 150 minus 5, that will make 9,60,000. So the taxable profit is 9,60,000. And what I said, to calculate the current tax, we need taxable profit. So taxable profit is 9,60,000, and we'll calculate the tax rate, or apply the tax rate. The tax rate is 30%. Tax rate is 30%. So 9,60,000 30%, that is 2,88,000. This will make 2,88,000. What is that? That is the current tax. So current tax is the tax calculated on taxable profit is known as current tax. So we calculated the current tax for the year. So how to record that current tax? So the entry for this one will be made, that is income tax expense debit, income tax expense debit, and income tax payable credit, income tax payable credit, income tax payable credit with the amount of 2,88,000, 2,88,000. So that is the entry we'll prepare for the current tax for the year in our accounts. So that was the treatment, that was the calculation we have to make it to adjust the accounting profit and to convert that accounting profit into a taxable profit, and then we'll apply the tax rate. So that was the calculation of a current tax. Okay. Moving on to the question number 2, and now we are going to learn regarding the prior period tax. What is prior period tax? But before moving on, I would like to take on board all the participants to let me know if there is any query, if there is any question regarding the current tax. I would definitely appreciate if you have any concern, if you have any query or any confusion regarding the current tax. So I would definitely recommend you. If there is any question or the query regarding the current tax. So we have completed the one part of a standard, that is how to calculate the current tax. And we are moving towards the next part, next phase, that is how to calculate or how to account for the prior period tax. Till that, if there is any question or query from the participants, so you are most welcome. Okay. So, okay, let's continue with that one. That is prior period tax. What is prior period tax? Prior period tax is basically the tax of a previous year, but it is calculated, but it is adjusted in the current year. What does it mean? Let me give you the overview of this one, that is prior period tax. Let me give you an overview for that is prior period tax. In most of the world, there's a concept of self-assessment. What does it mean? What tax authorities or the tax law says, you calculate the tax based on your assessment. For example, if I'm the company, government will tell me, or government will ask me to calculate the tax and pay that amount, based on your self-assessment, based on your self-judgment. What I thought, okay, so my profit for the year is, what I said, that my profit for the year is 15 lakh, based on my assessment, based on my judgment, and I applied the tax rate, that is 30%. 15 lakh. I just had an estimated profit of 15 lakh and applied the rate of 30%, and I calculated the tax 4,50,000, let's say in the year 20x6. And I paid that amount of tax. It was based on my assessment, on my judgment and my calculation, and I paid that amount of 4,50,000 to the authorities. Later on, the tax department will review your assessment. I said tax department will review your assessment. That is for example, in the year 20x7, they reviewed your assessment and they identified the tax you have calculated. The tax which I have calculated was 4,50,000, but instead of this, The tax should have been, that is 500,000. Tax should have been 500,000. It's not the 2007. It's not a tax for 2007. It is the tax of 2006. That means the tax should have been 500,000 for 2006. Now let's consider what's going on. You calculated the tax. 4,50,000 for 2006, but the tax authorities reviewed your assessment and they identified the tax should have been 500,000, not 4,50,000. That means the tax of a previous year, that means the tax of a 20x6, but it is now being adjusted in 20x7. What does it mean? You calculated the tax 50,000 lower. You calculated a lower tax, that is 50,000 lower tax you calculated in the previous year. Now the government will ask you to pay the difference amount. It means now that situation is known as what? Under provision. That situation is known as what? Under provision. That you made under provision in last year. You made under provision for the last year. It means you recorded the expense of the tax as 450. Actually, it was 500,000. So you need to increase the expense this year. So under provision, it means 50,000 will be recorded as an expense for this year. And what we are going to name it, it will not be named as a current tax because it's not a tax for the current year. It's not the tax for the current year profit. It's a tax of a previous year, but adjusted in the current year. So we will record that 50,000 as a prior period tax. We'll record that as a prior period tax. That is 50,000 will be recorded as a prior period tax. So that is the prior period tax. It is not necessary. It is not mandatory that there will always be under provision. For example, let's take an instance. For example, in 20x6, we calculated a profit of 4,50,000. But in 20x7, government reviewed your assessment and they identified the actual tax should have been 3,50,000. And I said again, it's not the tax for the current year in 2007. It's a review of assessment in 2007, and tax authorities have identified that you calculated a tax of 4,50,000, but the tax should have been 3,50,000. It means you have calculated more tax. You have recorded extra tax expense of 100,000. Now for this year, you need to now this situation will be considered as over provision. What does it mean over provision? It means you have over recorded the tax expense. It means it's an over provision. And now for this year in 2007, how we are going to adjust this one? We will reduce the tax expense by 100,000. Will reduce the tax expense. Will reduce the tax expense by 100,000 in 2007. The tax of a previous year, but adjusted in the current year, will reduce the tax expense in 20x7. So that is the basic idea or basic concept of the prior period tax. That what is prior period tax? The tax of a previous year, but calculated or adjusted in the current year. Let me give you one other information that is very important. Whenever you have a tax balance, in your trial balance, you have a tax amount in your trial balance, and if it is a trial balance and if it is a debit balance, so that means it's under provision. I repeat, normally we face these kinds of adjustment to final account, that in trial balance, tax balance is given with a debit balance. That means it's under provision. But if tax balance in the trial balance is given but with a credit balance, so it means it's a over provision. And what does it mean? Over provision means you have recorded excess tax in the previous year. What does it under provision means? You have recorded lower tax in the previous year. So what does it mean? If you are having an under provision, so you need to increase the tax expense. For the current year. But if it is the over provision, you need to decrease the tax expense. As you have recorded more expense in the last year. So that is the basic concept or idea of a prior period tax. So let's have a look on the question. So what is the question? Question number two. Simple has estimated, the company has estimated income tax liability for the year ended 31st December 20x8 at 1,50,000, $1,80,000. What is this? This is the income tax liability for the year ended 31st December 20x8. And let's evaluate, or that let's read out the requirement. Calculate the tax expense that will be shown in the statement of profit and loss for the year ended 31st December 20x8. It means we are going to calculate the tax for 20x8. So what is this? So this is the tax for the current year, which is already given. We can say that that is the current tax. Current tax is already given in the question. In the previous year, the income tax liability has been estimated as $1,50,000. It means in 2007, we estimated an income tax liability in the resultant of a self-assessment. We calculated a tax liability or tax expense 1,50,000 in the previous year. Now, what is it saying? That if the amount that was actually agreed and settled with the tax authorities in respect of 2007 was 1,50,000, these are the two independent cases. So first of all, let's consider this one, that is 1,65,000. It means the review of self-assessment said that your tax expense should have been 1,65,000, but you have recorded previously as 1,50,000. So definitely that is the case of under provision. That is the case of what? Under provision. You recorded a lower tax in the previous year. You recorded a lower tax in the previous year. You recorded a tax of 1,50,000, but it should have been 1,65,000. It means it's under provision case. Now let's calculate the income tax amount that should be reported in P&L. So first of all, we are having a required A, and to calculate the profit and loss amount, that income tax to be reported in P&L, we are going to calculate it by working one. And for working one, we know that in order to calculate the income tax, we have three different taxes that should be included. Number one, the current tax. Number two, the prior tax. And third one is the deferred tax. For now, we have no deferred tax, neither we have learned about it. So deferred tax is zero, but the current tax is given for the current year is $1,80,000. $1,80,000, that is the current tax. And now prior tax. We already calculated a tax of 1,50,000 the prior year, but this year the self-assessment review said that the actual tax should have been 1,65,000. It means that was an under provision. We need to calculate, or we need to increase the tax expense for this year with $15,000. $15,000. So the tax would be, income tax amount would be $1,95,000. That will be reported in P&L. That will be reported in P&L for the year 20x8, 31st December 20x8. I hope it's clear. Okay, now let's move on to required B. Required B, and what we are having in the required B. Required B, again we need to calculate the amount of income tax that should be reported in P&L again for the year 20x8, 31st December 20x8. But this time the assessment is little bit different. Again, we need to calculate the income tax for the year, and let's have a working one. And for working one, we definitely have three different types of taxes. That is, income tax will include three different taxes. Number one, the current tax. Number two, the prior tax. And third one is the deferred tax. Current tax, which is already given, that is 1,80,000. And prior tax, what about the prior tax? Prior tax, 1,50,000 was calculated and estimated in the previous year, but actually the tax was $1,40,000. It means that's an over provision. If this is the over provision by 10,000, it means for this year we need to reduce the tax. We need to reduce the tax expense for the current year, and there is no deferred tax for the timing. So that means 1,70,000 would be the answer, and income tax to be reported in P&L will be $1,70,000. $1,70,000 is the amount of income tax to be reported in P&L. So far what we have learned, let's quickly recap. We have learned regarding how to calculate the current tax and how to calculate or how to record the prior period tax. We have learned both the things in this session for so far. Now we are moving to the most important part of this session, most important part of this standard, that is the deferred tax. That is the deferred tax. So far, if any student or the candidate have any query, can raise the query, and I would definitely welcome. I would definitely welcome the queries. I would definitely welcome you all for the queries. So far, whatever we have done, if you have any query, you may raise. So far what we have discussed, let me recall, we have learned how to calculate the current tax. We have learned how to record or adjust the prior period tax. Current tax, which is calculated on a taxable profit, and we learned about it, how to calculate the taxable profit. Remember, we never calculate the tax on the accounting profit. We calculate current tax on taxable profit. So we need to adjust the accounting profit, and we need to calculate the the taxable profit, so that we can calculate the current tax. In second phase, we discussed regarding the prior period error, that what is prior period error? Tax of a previous year, but it is calculated and adjusted in the current year. And there might be two possibilities. There might be an under provision or the over provision. If there is under provision, what we have discussed, let me recall you what we have discussed. If there is an under provision, it means we'll increase the tax expense in the current year. But if there is an over provision, definitely we're going to decrease the tax expense in the current year. And we did it by practicing this question, that is question number 2, in which we calculated or we adjusted the prior period tax. In required A, there was an under provision. So what we did, we increased the tax for the year. That means 1,80,000 was the current year, but we increased the tax by 15,000. It means total tax to be reported in PNL 1,95,000. But in case B, or in the requirement B, there was an over provision. It means tax in the previous year was overcharged. So for this year, we reduced the amount of tax, and we calculated and we recorded our tax for the year is 1,70,000. Okay, now let's move on to the most important part of this session, that is the deferred tax. Now, what is deferred tax? What is the deferred tax? Deferred tax is calculated on temporary differences. So what does it mean? We can highlight that there might be two differences. There are two types of differences. The one is the temporary differences, and the other one is the permanent differences. There are two types of differences, that is the temporary difference and the permanent difference. Now, what is the difference between these two? Temporary differences are those differences which will be resolved in a future time period. In accounting and in tax, there are two differences. Temporary differences. For example, if any expenditure which I'm recording in my accounting records, but for the time being, tax department is not allowing you. Tax department will not allow you to record it as an expense. Yes, it will allow you. But in future time period. That means it's a temporary difference. There is a difference, but it's a temporary difference. And this temporary difference will be resolved in future. But permanent differences are what? The expense which I have recorded in my books of accounts, in my accounting records, but the tax department will never ever let you allow to record it as an expense. How is it could be possible? Let's take an example. The example of a temporary differences is accrued expenses. That is the what? That is the temporary difference. There are many expenses which we are recording in our accounting records, but for tax purposes, these expenses will be allowed to you. These expenses will be considered as an expense once these are paid. Once these are paid to the concerned, then the tax department will allow you as an expense. It means there is a difference for the timing, but that is a temporary difference. Likewise, accrued income, few revenues which I am recording few revenues which I am recording, accrued revenues, I am recording as a revenue, but the tax department will not allow you for the timing to record it as a revenue. Yes, tax department will allow you to record it as a revenue, but once you have realized it, but once you have received it, so it means these are the temporary differences. Let me identify you another temporary difference, that is the depreciation. Depreciation. We record the depreciation as 500,000 in the year one, but the tax department may allow you the depreciation as 1 million in the year one. There is a difference, but this difference might be, but this difference will surely be resolved at the end after 2 years or the 3 years or 5 years. So it means this is also a temporary difference. So these are the temporary differences between the tax and the accounting profits. But there are certain permanent differences. Likewise, penalties. In accounting, we are recording the penalties as an expense. But tax department will never allow you to record this penalty as an expense. They will never ever let you to record these penalties as an expense. They will never allow you to record this as an expense. Not today, not after. They will never allow you to record it as an expense. Likewise, donation to unregistered firms. Donations to unregistered firms. If you are making a donation to unregistered NGOs, you recorded that donation in your accounting profit. You recorded that donation as an expense in your accounting profit while calculating the accounting profit. But tax department will never allow you to record this donation as an expense because you have made that donation to unregistered NGOs or firms. So it means there are two differences in tax and accounting profit. We discussed that. We discussed the differences. Let me recall you the previous slide. These are the possible differences between the accounting and the tax profit. These are the possible differences that might arise while calculating the accounting and the tax profit. In these differences, there are some differences which are permanent. But there are many differences which are temporary. So it means differences could be divided in two categories. That is the permanent difference and the temporary differences. Temporary differences will be resolved in the future time period, but the permanent differences will never be resolved in future time period. So this is the difference between the permanent and the temporary differences. So deferred tax is calculated. Now the point one that is very important, that is deferred tax is calculated on temporary differences. Important point is deferred tax is never calculated on a permanent differences. Deferred tax is always calculated on a temporary differences. Number one. Now, these temporary differences could be divided. In two categories. It means that is TTD and DTD. TTD stands for what? Taxable temporary difference. Taxable temporary differences. TTD stands for what? Taxable temporary differences, and DTD stands for what? Deductible temporary differences. So there are two types of temporary differences, that is taxable temporary differences and deductible temporary differences. What does it mean and what is the difference between these two? There are differences, the differences which might give you a benefit at present. I repeat, might give you a benefit at present, but remember, you should not be happy with that one. You shouldn't be happy with that one. If the difference which is giving you a benefit at present might charge you in future. For example, let me give you an example. Accrued expense. What I did, I recorded an accrued expense, salary expense debit and salary payable credit in my accounting record. Accounting records. In accounting profit, I recorded that expense debit and payable credit. I recorded that as an expense, accrued expense in my accounting record. Now the tax department will say you that we will not consider that as an expense, will not consider that as an expense. It means, what is this? This is a taxable temporary difference. It's a taxable temporary difference. It's a taxable temporary difference. One more example. Accrued income. I recorded accrued income. For example, commission receivable debit and commission income credit. I recorded this as a revenue in my P&L, that is accounting profit, but the tax department will recognize this as a revenue in future. In future, when the revenue is actually received, when the commission is actually received. But for the timing, I recorded that commission as a revenue. Now consider the situation. I recorded that commission receivable debit and commission revenue credit in my P&L, in my profit and loss account. I recorded that as a revenue. But tax department will not allow you to record it as a revenue. What the tax department will do, will reduce your profit. What I said, will reduce your profit. Why? Because that tax department is not considering, will not consider that as a revenue. Yes, the tax department will consider it as a revenue, but in future, when actually you will receive that amount. For the time being, the tax department will reduce that revenue, will eliminate that revenue. And once the revenue is eliminated, revenue is removed, it means your profit will also be reduced. If your profit is reduced, definitely your tax amount will also be reduced. Is it so? Yes. Your tax department will be, your tax amount will also be reduced, because the tax department removed that revenue. But if the tax department has removed that revenue, it means your profit will be reduced. And once that profit is reduced, the tax amount will also be reduced. So you're happy now. Okay, that's great. Tax department reduced my profits. Tax department reduced my tax amount. Yes, you are happy right now. Will give you a benefit at present. But don't be so happy. Why? Because you have got the benefit today. But this will tax you in future. This will charge you in future. What does it mean? This will tax you in future. Once you will receive cash from commission, once you will receive cash, the tax department will consider that as a revenue. The tax department will consider as a revenue, either if it is in the next year or after 2 years. Whenever you will receive that amount, tax department will consider it as a revenue. So that is the difference which will tax you in future. So in short, if I say what is taxable temporary difference, that is the difference which will tax you in future. That is tax you in future. That is the difference. Will save you today. That it is the difference. It is a kind of difference that will save you today. But remember, it will tax you in future. You should be aware about it. You should be aware of it, that you are not saved. You're not saved. You will get the benefit today, but remember, you will have to pay the tax on that amount in future. So it means this will tax you in future. You should be mentally prepared for this one. IS 12 says you have to be mentally prepared for this one. How to be prepared? How to get yourself prepared? How to get yourself prepared for this one? The tax department or IS 12 says, income taxes says, if you know, if you're sure, if you're confirmed that it will tax you in future, so what are you waiting for? Don't wait for it. Just recall the accrual concept and the prudence concept. What they said you, what they told you, what they guided you. They always guided you to calculate and to record the expenses if they are incurred or paid, to record the expenses, to record the expected loss. That is unavoidable. You have to record that expense and the loss. If you know that you have to pay that amount, you have to bear that loss. In future, you have to record that amount as per the prudence concept. Future expected losses unavoidable losses should be recorded. So it means you have to record that loss or the expense. You know that you will be taxed in the future. So let's record that expense. So how to record that expense? We will recognize that expense as a deferred tax expense debit and deferred tax liability credit. Deferred tax expense debit and deferred tax liability credit. What does it mean? Let me recall this one. Let me recall this one. Let me give you a summary of this one. What we have discussed. If we are having a difference, if you're talking about the difference, we have two different differences. That is the temporary difference and the permanent difference. Temporary difference. I give you an example for the temporary differences. This might be accrued expenses, depreciation, and accrued revenue. Differences could be divided in two. Temporary differences could be divided in two. That is taxable temporary difference and the deductible temporary differences. Taxable temporary difference. What does it mean? What does it mean? It means you will be benefited today, but you have to pay the extra tax. You have to pay some tax. It's not the end. You shouldn't be happy right now. Why? Because that difference will tax you in future. So it means any difference which will tax you in future is known as what? Taxable temporary difference. And in short, if there is a taxable temporary difference, we'll recognize the entry as deferred tax expense debit and deferred tax liability based on the accrual concept, based on the prudence concept, based on the IAS 37, that is provision. It is basically the provision for the future tax. It is basically the provision for the future tax expense. So we made a provision. We made a provision that is deferred tax expense debit and deferred tax liability credit. As we know that this difference will cause you a tax. This difference will cause you a tax. So for this, we made a provision today, that is deferred tax expense debit and deferred tax liability credit. Let me give you the example for the deferred tax, deductible temporary difference. And what is this deductible temporary difference? It is the difference will give you a penalty or will charge you today. Will charge you today. Will charge you today. Will tax you today. But don't worry. Don't worry, dear. Tax will be saved or you will be benefited in future. You will be benefited in future. Don't worry, you will be benefited in future. For example, accrued expense. I recorded an accrued expense of salary expense debit, and salary payable credit. I recorded that accrued expense in my accounting records. Tax department said, we will not recognize, we will not consider that expense. Remove that expense from your accounts. Okay. So we remove that expense from our accounts. Expense reduced. It means if expense reduced, your profit will be increased. And if your profit is increased, it means your tax amount will be increased. It means your charge today. That difference will charge you today, will cause you today, will harm you today. But don't worry, in future, when you will pay that salary to your employee, the tax department will allow you that as an expense. Tax department will allow you to that expense. And once it will allow you for the expense, your profit will be reduced and then your tax amount will also be reduced. So what does it mean? That is the difference. It is the difference which is causing you, which is making a higher tax today, which is making you a higher tax today. But don't worry, in future, this will reduce your tax amount. So that kind of differences are known as what? Deductible temporary differences. It means that difference will reduce, that will deduct your tax in future. For this kind of deductible temporary differences, what we do, we make an entry for deferred tax expense. As we all know that, we are charging, we have been charged today. We have been charged today for the tax, but in future we will be relaxed. We will be giving a relaxation, and we will be giving a lower tax. We will be giving a lower tax in future. So we know that we will be giving a lower tax, and it's a revenue, it's a benefit. So let's recognize that benefit in advance, and we will record that it as a deferred tax asset debit and deferred tax income or deferred tax expense credit. That means will reduce the expense. So this entry will be made if there is a deductible temporary difference. Now let's recall temporary difference. If it's a taxable temporary difference, it means we will recognize the deferred tax liability, will recognize the entry as deferred tax expense debit and deferred tax liability credit. But if it is a deductible temporary difference, we'll recognize that a deferred tax asset and the entry will be made in the accounts as deferred tax asset debit and deferred tax expense credit. Is it clear so far? We have just discussed the basic of what is deferred tax and what are two differences and how to account for those two differences. Is it clear so far? If you have any queries so far, please raise your query. Yes, if there is any issue, if there is any concern, if there is any question, you may raise your question through chat box. If any candidate has some query, you may raise in chat box. Definitely we are going to practice it right now. We will definitely practice it, how to calculate the deferred tax and how to recognize it. One so far I have given you just the idea what is deferred tax. Okay, if there is no query, let's move on. Now let's let's move on and deferred tax. Deferred tax, that is to calculate the deferred tax. We have two different approaches. That is number one, the income statement approach. Income statement approach, and other is the balance sheet approach. It means if you want to calculate the deferred tax, IS 12 suggests there might be two approaches, that is the income statement approach and the balance sheet approach. There might be two approaches, that is the income statement and the balance sheet approach. But IS 12 suggests, and most of the time in practical life, in practical in a different organization, whenever we calculate the deferred tax, we usually calculate deferred tax by using the balance sheet approach. That is quite simple and easy, and it's a very precise way to calculate the deferred tax by using the balance sheet approach. So balance sheet approach is most favorable and it is most recommended method or the approach to calculate the deferred tax. So in this session, and with respect to your paper point of view, if I talk about the paper pattern or the paper point of view, examiner will definitely recommend, your examiner will definitely test you for the deferred tax by using the balance sheet approach. So we are not going to discuss the income statement approach, how to calculate the deferred tax by using the income statement approach. So once we are talking about the balance sheet approach, so it means balance sheet, we have two basic components, that is assets and liabilities. So we can say that deferred tax will arise on either the assets or the liabilities of the company. Deferred tax will arise either on the asset or the liabilities of the company. It means when we are calculating the deferred tax for the year, we must consider the assets and liabilities of the company. Deferred tax may arise on the asset or it may arise on the liabilities. Now, what will be the rules for this one? That is, the rule is if the carrying amount, CA means, CA stands for what? It's not a chartered accountant. It means the carrying amount. If the carrying amount is greater than the TB, TB stands for trial balance. No, it's tax base. TB stands for what? It's a tax base. If the carrying amount is greater than the tax base. Now, first of all, we need to evaluate, we need to consider, we need to understand what is carrying amount and tax base, because in our minds, in our opinion, what is carrying amount? Carrying amount is basically, so far what we have learned about it regarding the carrying amount, what we have learned regarding the carrying amount, that is cost minus accumulated or the allowance for depreciation. But for this standard, carrying amount is not that. Carrying amount is not that cost minus accumulated depreciation or the allowance for depreciation. So what is carrying amount? Carrying amount means Carrying amount means the value of assets and even liabilities. Value of assets and liabilities as per accounting records. As per accounting records. Yeah, it means carrying amount. What is carrying amount? Carrying amount is the value of assets and liabilities as per your accounting records. For example, I said in my accounting, in my books, the value of furniture is 500,000. It means the cost minus accumulated depreciation, that is 500,000. That is a carrying amount, which is quite obvious. But what if I said the value of salary payable? The value of salary payable in my accounting record is 5 lakhs. So what is that 5 lakh? That 5 lakh is the carrying amount of your liability. So what is the carrying amount? Carrying amount is basically the value of assets and liabilities as per the accounting records. In this standard, in this chapter, in this phase, in this area, we will not be so that carrying amount means accumulated depreciation after deducting the accumulated depreciation. That is not the case. It means the carrying amount is basically the value of asset and liability as per your accounting records. That is the carrying amount. And what is tax base? And now the tax base would be quite obvious. Tax base would be quite obvious. That means the value of assets and liabilities as per tax records. As per tax records. It means if you say that the value of asset as per the accounting record is 500,000, but as per the tax record it is 700,000. It means now the carrying amount is 500,000 and the tax base is 700,000. It means the value of carrying amount, value of asset and liability as per accounting record is known as carrying amount, and the value of asset and liability as per tax record is known as tax base. So that is the difference between the carrying amount and the tax base. Now what the IS 12 says, that if carrying amount of asset, or if the carrying amount of the asset is greater than the tax base of an asset, it means that will be recorded as a taxable temporary difference. What does it mean? It is the difference which will tax you in future. It is the difference. What does it mean? It means if your asset carrying amount is greater and if your tax base is lower, if you are having a greater carrying amount and a lower tax base, it means the value of asset is 700,000 and the tax base is 300,000. It means there is a difference. Yes, there is a difference. There is a difference of 700 and 300. It means there is a difference of 400,000. So this is the difference which will tax you in future. This will tax you in future. So don't be so happy. Record the tax expense right now, as you know that it will tax you in future. So don't wait for the time, don't wait for the excess time period, don't wait for that time period. Record the tax expense right now. It means this will be considered as a TTD, that is taxable temporary difference, and recognize the deferred tax liability for the year. Recognize that deferred tax expense today, as you know that this will tax you in future. But on the other hand, on the vice versa, if tax base is greater than carrying amount, you just learn one rule, and by reversing it, you will get the answer of the on the other hand. If tax base is greater than carrying amount, it means it will not be a TTD, it will be a deductible temporary difference. I repeat, if tax base is greater than carrying amount, just recognize one rule and you will definitely shuffle, or you will reverse that rule. And tax base is greater than carrying amount, it means it is not a taxable temporary difference, but now it is a deductible temporary difference. It will save you in future. So let's record the revenue or asset right now. It means now the deferred tax asset will be recorded. Deferred tax asset will be recorded. And the opposite rule for the liabilities. For asset, what was the rule? Carrying amount is greater than tax base, recognize taxable temporary difference. But if in case of liabilities, carrying amount is greater than tax base, recognize it as a deductible temporary difference. What I said, remember, memorize the one rule, memorize only that one, only memorize that one. You will definitely learn all of the rest of the rules. If carrying amount of an asset is greater than the tax base, it means you will recognize it as a deferred tax liability, that is taxable temporary difference. But if in case of liability, carrying amount is greater than tax base, now you will not recognize as a deductive or taxable temporary difference, but you will recognize as a deductible temporary difference, that is the deferred tax asset. So that is the summary of deferred tax. And now calculate, let's try to practice it out, how to calculate, the deferred tax, how to calculate the deferred tax. Let's try to calculate the deferred tax. James Company profit before tax and depreciation is $200 million each year. It means that is the profit before tax and depreciation. Depreciation has not yet been accounted for year 1 till year 4. Okay, it means it is assumed that the profit for all year is same. That is, year 1 the profit is 200 million, year 2 the profit is 200 million. Obviously it's not visible, but we are assuming right now that the profit for each year is same. Asset cost is $120 million at year 1, and asset life as per tax is 3 years. What does it mean? It means tax department has recommended you a life of 3 years. Asset life as per accounting record is 4 years, and the rate of tax is 30%. Compute the current and deferred tax. We have to calculate two taxes here, that is the current and the deferred tax for year 1 till year 4. Now let's calculate the current tax. First of all, let's calculate the year 1, year 2, year 3, and year 4. We have profit before tax and depreciation. We have profit before tax and depreciation. Profit before TD, that is profit before tax and depreciation, 200 million in all accounting period, it is assumed. Okay, now we are going to calculate the profit, that is on which we will calculate the current tax. So definitely we are going to calculate the taxable profit. We are going to calculate the taxable profit. I told you earlier in the start of the session that how to calculate the current tax. Current tax is calculated on a taxable profit. It means we need to calculate the profit as per tax laws. Now that is the profit, and definitely if you want to calculate the tax, that is the current tax, we need to record the depreciation as per tax laws, and as per the tax laws the life of the asset is 3 years. The asset cost is 120 million. It means we are going to deduct the tax depreciation. Tax depreciation, we will not deduct the accounting depreciation because we are going to calculate the taxable profit. Taxable profit. So tax depreciation, how are we going to calculate the tax depreciation? 120 was the life of, it was the cost of asset, and as per the tax laws, the life is 3 years. It means 40,000 depreciation will be recorded in the year 1, and 40,000 depreciation will be recorded in the year 2, and 40,000 depreciation will be recorded in the year 3, and no depreciation will be recorded as per the tax laws in year 4 because the life of the asset was 3 years and we depreciated that asset for 3 years. So now the amount, that is profit before tax and depreciation, was 200 million. Now we deducted the depreciation. Now the profit will be 160 million, and the profit for the last year would definitely be 200 million. So that is known as what? That is known as taxable profit. That is known as what? A taxable profit. And now we are going to apply the tax rate on this one. Tax rate, and the tax rate was 30%. So let's calculate. The tax is 48, and definitely for the year 2 is 48, year 3 is 48 and 200, and for the last year this will be $60. So that is the tax rate, and we calculated these figure and we recognize this one as a current tax. We'll recognize this as a current tax. So it means the current tax of a year 1 is 48, current tax for the year 2 is 48, and current tax for the year 3 is 48, and the current tax for the year 4 is $60. That is 60 million is the current tax. But that is not the end. We have completed the one requirement, that is the current tax. Now we are going to calculate the deferred tax. How to calculate the deferred tax? I told you that to calculate the deferred tax, now to calculate the deferred tax, let's calculate the deferred tax. And how we going to calculate the deferred tax? We just learned about it. Okay, so that deferred tax is calculated on assets and liabilities. So far we don't have any liability, and exams most of the questions will be tested on assets. Definitely will practice the liability section as well, but majority of the time, most of the time, deferred tax is calculated on asset, and in exams it is important that you know how to calculate the deferred tax on asset. So let's calculate the deferred tax on asset. We'll calculate the deferred tax for again 4 years. That is year 1, year 2, year 3, and year 4. Okay, now we have one asset, that is property, plant, and equipment. Let's say to calculate the deferred tax, what we said, we need to identify two things, that is the carrying amount and the tax base. Carrying amount and the tax base. So carrying amount of an asset means the value of asset as per the accounting records. So accounting report, as per the accounting records at the end of the year 1, always remember taxes are always calculated at the end of the year. So it means the carrying amount of asset at the end of the year 1, the asset cost was 120 million. Asset cost was 120 million, and as per accounting records, depreciation should have been charged over the period 4 years. Over the period of 4 years. Over the period of 4 years, it means depreciation will be recorded 30,000 for the 1 year, 30,000 for the year 1. It means the carrying amount of the asset would be 120 minus 30. Are you getting the point? That is the carrying amount. Value of asset at the end of the year 1. At the end of the year would have been 120 minus 30. That is 90. That is 90. It means the carrying amount of the asset at the end of the year 1 would have been 90. And then again at the end of the year 2, it means 120 was the cost of asset. We deducted the depreciation for the year 190, and when we are moving towards the year 2, we'll deduct the depreciation again 30 million in the year 2. It means total accumulated depreciation would have been 60. It means 120 minus 60, that is 60,000. 60 million would be the carrying amount of asset at the end of the year 2, and 30,000 would be the amount or the carrying amount at the end of the year 3, and 0 will be the amount at the end of the year 4, because in the year 4 total accumulated depreciation would be 1,20,000, and 120 will all 1,20,000, 120 accumulated depreciation will be deducted. So the carrying amount at the end of the year 4 would be 0. Okay, now coming back to the tax base. According to the tax base, the depreciation is calculated over 3 years. It means depreciation for a single year is 40. So at the end of the year 1, 120 minus 40, that is 80, and then 40, and then 0. It means the tax base at the end of the year 3 will be 0. Now calculate the difference. 90 minus 80, that is 10. 60 minus 40, that is 20. 30 minus 0, that is 30. And 0, it means there will be no difference at the end of the year 4. Now, what is that difference? That is the difference between the carrying amount and the tax base. And what I said, carrying amount and tax base. If an asset carrying amount is greater than the tax base, if carrying amount is greater than the tax base, that's in the situation. Carrying amount is 90, tax base is 80. Carrying amount is greater than the tax base. That difference is known as what? TTD, that is taxable temporary difference. In year 2, carrying amount is greater than tax base. TTD, that is the taxable temporary difference. In year 3, carrying amount is greater than tax base. Again, the difference is taxable temporary difference. And whenever there is a taxable temporary difference, this will arise, this will create a deferred tax liability. That means the deferred tax expense for the year. Now, how we are going to calculate this one? That is, we will apply the tax rate, and the tax rate is 30%. I guess 30%, yes. 30%, that is 30% will be applied on each year. So the deferred tax liability is 3, 6, 9, and definitely 0. So what is that? That is the deferred tax liability. Now, the point should be remembered. The point should be remembered that we have calculated the carrying amount at the end of the year. We calculate the tax base at the end of the year. We calculate the difference, that is taxable temporary difference, at the end of the year. So we calculated the deferred tax liability at the end of the year. It means that deferred tax liability is a closing balance. That deferred tax liability is a closing balance. Again, in year 2, we calculated the carrying amount at the end of the year 2. We calculated the tax base at the end of the year 2, and we calculated the difference, that is taxable temporary difference, at the end of the year 2. So it means once we are applying the percentage on this one, we are calculating the deferred tax liability at the end of the year 2. That means that is the closing balance. So you must be remembered, you must recall, you must point out that whenever we are calculating, we are applying percentage on the deferred tax liability. We are applying percentage on a deferred tax liability. Make sure that that is the deferred tax closing balance. That is the deferred tax liability closing balance. It is not the deferred tax for the year. It is not the deferred tax for the year. I recall, I repeat, whenever you are calculating the percentage on the deferred taxable temporary difference, because these taxable temporary differences are calculated at the end of the year, these are the closing taxable temporary differences. Whenever you are applying the percentage on the taxable temporary differences, you will be arriving at the deferred tax liability closing balance. So it means that is a closing balance, and we need to recognize the deferred tax for the year. We need to recognize the deferred tax for the year. So how are we going to calculate the deferred tax for the year? So let's prepare the ledger. Let's prepare the ledger for deferred tax liability. Deferred tax liability. If we calculate, if we know that the year 1, the closing balance of the deferred tax liability is 3, it means the closing balance is 3. And that is the first year of an asset. It means there was no opening balance, that is opening balance is 0. It means the deferred tax for the year, it means the deferred tax, the difference, deferred tax for the year would have been, that is the shorter side is credit side is shorter. It means we'll recognize $3 and we'll recognize this as a deferred tax expense. Deferred tax expense. That is the deferred tax expense for the year. It means we'll recognize the entry as deferred tax expense debit and deferred tax liability credit with $3 million. With $3 million. We'll recognize the deferred tax expense for the year is 3 million. That is deferred tax expense debit and deferred tax liability credit. Okay, let's move on. Once we have recognized this closing balance, this will become the opening balance of the next accounting period. Recognize the opening balance as net for the next account period, that is year 2. At the start of the year 2, the opening balance would have been 3 million. Now again, that 6 million is what? That is the closing balance of deferred tax liability. Again, we'll recognize the closing balance at the end of the year 2, that is 6 million. Now let me know what is the deferred tax for the year. So deferred tax for the year is 3 million. That means deferred tax expense, that is for the year 2, is 3 million. It means we'll again recognize that is the deferred tax expense for the year. And what accounting will entry will have should have been prepared for this one? Deferred tax expense debit and deferred tax liability credit, again with the amount of 3 million. With the amount of 3 million, deferred tax expense debit and deferred tax liability credit. Again, the closing of the year 2 will definitely be the opening of the year 3. Year 3 opening balance, that is 6 million. And again, year 3, 9 million. That is the deferred tax, but that is the deferred tax liability closing balance. And again, the closing balance, year 3, closing balance 9 million. And we will recognize again the deferred tax expense as 3 million, 3 million as an expense for the year. Again, the entry will be prepared for the year 3, deferred tax expense debit and deferred tax liability credit for 3 million. 3 million. We'll recognize the deferred tax expense debit and deferred tax liability credit for 3 million. Now, let's recognize the closing balance. That is year 3 opening balance. Year 3 opening balance. Definitely it would be 9 million. And now what's saying is, what is the closing balance of deferred tax liability? What is the closing balance of the deferred tax liability for the year 3? Now the closing balance is 0. Now the closing balance is 0. Now what will be the accounting entry for this one? Now shorter side is the debit side, and debit side is shorter by 9 million. It means now we'll recognize this as a deferred tax expense, and the accounting entry will be prepared for this one is deferred tax liability debit. Now deferred tax liability is debit. Deferred tax liability is debit, and deferred tax expense is credit for amount that is 9 million. I repeat. Deferred tax liability deferred tax liability debit and deferred tax expense credit 9 million. Now what is that scenario? Basically, you made a provision for the last 3 years. You made a provision for the last, just like provision for dismantling, you made a provision for every year, or you recognize the unwinding of the provision every year, and the day will come, the time will come, you will fulfill all your obligation, and you will remove that liability or the provision from your books. Now the day has arrived. Today we calculated, we made a provision for the last 3 years, and now today is the day when the differences will be handed over. As you can see this, at the end of the year 4, there is no as such differences, there is no differences. So if there is no difference, it means now the time will come, we will remove that deferred tax liability from our books, and we remove that deferred tax liability for the amount we created in the last 3 years, that is 9 million deferred tax liability debit and deferred tax expense credit. So these entries will be prepared in the 4 years accounting period for the deferred tax. It means in the year 1, you recognize the deferred tax provision as per the IS 37, as per the prudence concept. You recognize an expense as a liability in the year 1, again in the year 2, again in the year 3, and then in year 4, you remove that provision, that is deferred tax liability debit and expense credit. But you must remember, consider this one. Deferred tax is a liability. Deferred tax is a provision, but it is that provision in which there is no outflow of cash, will not recognize or will not pay off any cash at the end of its settlement. At the date of settlement, we will not recognize as a cash outflow, but will recognize or will adjust the expenses or revenues which we have adjusted prior in prior years. So the deferred tax for the year is 3 million. That is year 1. Year 1 deferred tax is 3 million. And let me make a summary over here. So now let's summarize this one. And if we calculate the total tax expense, if we calculate the total expense, that is for year 1, year 2, year 3, and year 4. We all know that to calculate the income tax, we need 3 types of taxes. That is the current tax, number 2, the prior tax, and the deferred tax. The current tax, prior tax, and deferred tax. So year 1, the current tax was that is 48. In year 2, it was the same. Year 3, it was the same. But in year 4, it was $60. In prior tax, there was no prior tax in the question. No prior tax was in the question. Deferred tax for the year 1. We have calculated the deferred tax for the year 1. Year 1 deferred tax is 3 million. That is 3 million. We record it as a deferred tax expense debit. So 3 million as an expense. 3 million as an expense in the year 2 and 3 million expense in the year 3. But just look at the entry of year 3, sorry, year 4. What we have done, we credited the expense with $9 million. What does it mean? We reduce the expense in the year 4. It means once we are reducing the expense, in the year 4, will not increase our expense but will decrease the expense by 9 million. Deferred tax expense is credited, it means reducing the expense. So to total expense to be reported in PNL, that is 51, 51, 51, and again 51. That is the income tax to be reported in PNL is 51 for the year 1 and year 2 and year 3 and year 4. I hope that's clear now. So that was the practice of how to calculate the deferred tax. Now moving on to the question number 4. Custard company purchased an asset. Custard company purchased an asset costing $1,500 at the end of 20x8. The carrying amount is $1,000. The cumulative depreciation for tax purposes is $900 and the current tax rate is 25%. You just calculate the deferred tax liability. For asset. How we going to calculate the deferred tax liability? We know that deferred tax is calculated on assets and liabilities, and for now we have an asset, that is property, plant and equipment. We are going to calculate the carrying amount and the tax base. Always remember, whenever the examiner asks you for the deferred tax, you just need to calculate the deferred tax. You just need to calculate the current carrying amount and the tax base. You need to identify the carrying amount and the tax base. So carrying amount at the end of the year 1 is given, that is $1,000. And we need to calculate the tax base. So how we going to calculate the tax base? The cost of the asset is $1,500, and for tax purposes the depreciation is $900. So 1,500 minus 900. 1,500 minus 900, this will make 600. That means the tax base is 600. So there is a difference, and that difference is taxable temporary difference. Why? Because the carrying amount is greater than the tax base. It means the difference is 400, and that difference is known as what? Taxable temporary difference. Will apply the percentage. One more thing that student usually makes a mistake, that student normally consider this 400 as a deferred tax liability. It's not the deferred tax liability. The difference of the carrying amount and the tax base is basically the difference, that is taxable temporary difference of $400. So we'll recognize the deferred tax liability on this one. It means 400, and we'll recognize the deferred tax liability. The percentage of tax is 25%. So 400, and we'll apply the percentage of this one. This will make 100, and this is what the deferred tax liability. And again, I repeat, this is the deferred tax liability closing balance. So far, we don't have any opening balance right now. And we are having a closing balance of 100. So it means the deferred tax expense for the year will be recorded as $100 million. That is $100 will be recorded as a deferred tax. It means the deferred tax for the year is $100. I hope it's clear. 2 points that you must remember. Number one, the point number 1 is the difference you have calculated, that is 400, is not a deferred tax liability, it's a taxable temporary difference. And the point 2, you must remember that once you are applying the percentage and the amount you have arrived, it's not the deferred tax for the year. It's a deferred tax liability closing balance. You have to calculate the deferred tax expense for the year. Okay, now moving on to the question number 5. Question number 5. Gripper Rod Company buys an item or the equipment on 1st January 20x1 for $1 million. It has a useful life of 10 years and estimated residual value is $100,000. The equipment is depreciated on a straight line basis, but for tax purposes, a tax expense can be claimed at a 20% reducing balance method. Tax rate is 30%. Calculate the deferred tax charge or credit in the company's statement of profit or loss for the year ended 31st December 2002 and the deferred tax balance in the statement of financial position at that date. It means you need to first observe there is a balance, there is a value of asset on 1st January 20x1, and we are going to calculate the deferred tax for 2002. It means after 2 years. After 2 years, that is 2001 and 2002. So at the end of the year two, you need to calculate the deferred tax expense or the liability. So how we are going to calculate? First of all, we need to calculate. We need to calculate that is the deferred tax at 31st December 20x1, because we cannot calculate the deferred tax for 2002 unless we calculate it for 2001. For this one, we need the carrying amount. We need the carrying amount and the tax base for the asset. Carrying amount means asset, value of asset as per the accounting record. So accounting records says that we are going to follow the straight line method, and 1 million is the cost of asset. The life of the asset is 10 years, that is the depreciation is 10. Depreciation is 1 lakh, and carrying amount at the end of the year one will be 9 lakh. 9 lakh. And for tax purposes, they follow the reducing balance method, that is 1 million. And the tax rate is, sorry, depreciation rate is 20%. It means the carrying amount would be 8 lakh at the end of the year as per the tax, sorry, tax base would be 8 lakh at the end of the year one. So now let's calculate the difference. It is basically a taxable temporary difference. It is basically a taxable temporary difference. As the carrying amount is greater than the tax base, that means the taxable temporary difference is 1 lakh, and we'll apply the percentage, that is 30%, and 1 lakh 30%, this will make 30,000. This will make 30,000, and I repeat, it's a deferred tax liability closing balance. Deferred tax liability closing balance. But the question is, if it is the deferred tax liability for deferred tax liability closing balance, we need to calculate the deferred tax for the year. So for this one, let's prepare the ledger. Do we have any opening balance? No, we don't have any opening balance. Do we have the closing balance? Yes, we do have a closing balance of 30,000. So deferred tax expense for the year is 30,000. Deferred tax expense for the year is 30,000. So for the year one, the deferred tax expense is 30,000. But remember, we are not here to calculate the deferred tax for the year one. We need to calculate the deferred tax for the year two. So now let's move on to the 31st December 20x2. Again, we are going to calculate the carrying amount and the tax base of asset, that is property, plant and equipment. And carrying amount at the end of the year one was 9 lakh. Again, the depreciation of 1 lakh will be deducted. So the carrying amount will be 8 lakh. Because in the straight line, we have a equal or the same depreciation. Okay, now tax base. In tax base, we do have a tax base value 8 lakh, and we'll charge a depreciation of 20% on this one. That is 1,60,000. So 8 lakh minus 1,60,000. This will make 6,40,000. So the tax base is 6,40,000. Now the difference is taxable temporary difference, because carrying amount is greater than the tax base, and the difference is 800,000 minus 640, that is 1,60,000. Again, we'll apply a percentage, that is 30%. 1,60,000, 30%, that is 48,000. Now my question is whether that 48,000 is a deferred tax expense for the year. No, that is not the deferred tax expense for the year. It's a deferred tax liability closing balance. I kept on repeating, this is not the deferred tax for the year. It's a deferred tax liability closing balance. Now let's calculate the deferred tax for the year. We'll make a ledger, and definitely now we have an opening balance of deferred tax liability. It means the closing of the year one will definitely be the opening of the year two. 30,000 is the deferred tax liability opening balance, and now we have calculated the deferred tax liability closing balance, that is 48,000. It means the deferred tax for the year will be $18,000. That is deferred tax expense debit and deferred tax liability credit. I hope it's clear to you. I hope it's clear to you. You must be very conscious. You must be very alert that 48,000 is not the deferred tax for the year. It's a closing balance. It's a closing liability. And we calculated the deferred tax for the year, that is 18,000. So summing up, as per the requirement, if we prepare the PNL for the year 31st December 20x2, so income tax that should be reported. Three types of taxes: current tax, prior tax, deferred tax. So far in this question, we don't have any profit. So no current tax is there, no prior tax is there. But yes, the deferred tax for the year 2002 is 18,000. 18,000 is the deferred tax for the year, and that is the tax will be reported in PLN. But for balance sheet, if we talk about the balance sheet at 31st December 20x2, we will definitely book a liability, that is deferred tax liability. And in balance sheet, we always incorporate the closing balances. So closing balance of the deferred tax liability is 48,000. So 48,000 will be reported in balance sheet as a deferred tax liability, and this will be stated as a long-term liability, as we know that, as we don't have any sufficient information when this liability will be handed over. So we'll consider that as a deferred tax liability, as a long-term liability. Long-term liability, 48,000. I hope that question is clear to you now. Okay, now we have a question as a practice question in which we need to identify the carrying amount and the tax base. Carrying amount and the tax base. We have different transactions or the different assets and liabilities. A machine costs 10,000 and has a carrying amount of 8,000. It means the cost is 10,000, but the carrying amount is 10,000, 8,000. For tax purposes, depreciation is 3,000, has already been deducted in the current and the prior period. Okay, now the carrying amount definitely already given in the question, that is 8,000. So carrying amount is 8,000. And the tax base will be 10,000 is the cost, tax depreciation is 3,000. It means the tax base would be 7,000. Most of the time, examiner asks you to identify the carrying amount and the tax base of the assets and liabilities. For this asset, we identified the carrying amount as 8,000 and the tax base as 7,000. Okay, so can you please let me know what will be the difference? What will be the difference? So difference would be either TTD or DTD. TTD stands for taxable temporary difference or a deductible temporary difference. If carrying amount of an asset is greater than the tax base, it means there is a difference of 1,000 and difference will be recognized as a taxable temporary difference. Taxable temporary difference. Okay, another, that is interest receivable. Again, an asset has a carrying amount of 1,000 already given in the question. That is 1,000 is a carrying amount. The related interest revenue will be taxed on a cash basis. It means tax department, as per the tax laws, interest receivable will not be recognized. It means tax department will not recognize it as an asset. It means as per the tax base, the value of asset is zero. The value of asset is zero. It means there is a difference, but the difference is 1,000. And again, carrying amount is greater than tax base. It's a taxable temporary difference. Third, trade receivable. Again, an asset has a carrying amount of 10,000. Already told you about it, that the carrying amount of an asset is 10,000. The related revenue has already been included in the taxable profit. What does it mean? It means you recognize it as a receivable, as a revenue. Tax department also allowed you. So how is it possible? In some cases, there is a possibility the tax department will also consider as a revenue. And in that case, tax department allowed you as a revenue. What does it mean? The value of asset as per the accounting record is 10,000 and tax department also recognize this as a revenue. It means it is also recognizing as an asset. It means the value of asset as per the tax is 10,000. It means there will be no difference. There will be no difference. Last transaction, a loan receivable, again an asset, has a carrying amount of $1 million. Carrying amount of $1 million. It means the value of asset as per the accounting record is $1 million. The repayment of loan will have no tax consequences. What does it mean? The tax department has already recognized that amount and will not recognize once the loan will be repaid. So it means, or the loan amount will be received. It means tax department has already recognized, has also recognized this as an asset, which means tax department has considered this as an inflow. It means tax department has recognized this as a asset or revenue. It means there will be no difference again and no taxable temporary or deductible differences will be recognized. So this was the activity, and you must be prepared for this one. Your in exams, a question might arise, might come to you, that in which you have to identify the carrying amount and the tax base and the difference of the carrying amount and tax base. Okay, now coming to the revaluation of a non-current asset. As we all know that in accounting, we might adopt a revaluation model, and once we are adopting a revaluation model, we recognize asset at the market value, and once we are recognizing the asset at the market value, we usually recognize an entry or record an entry as property, plant and equipment debit and revaluation surplus credit. Although we consider this as an unrealized gain, but for accounting purposes, we recognize this entry and we increase the asset, increase the value of asset. But for tax purposes, but for tax purposes, but for tax purposes, always remember, tax department will never allow you. Tax will not allow you. Tax will not allow you. Yes, this will allow you. Tax department will allow you, but once you have disposed of that asset, this will allow you the gain on disposal. But today you have not yet disposed that asset. It means this will not allow you today. It's a temporary difference. So there might be a possibility because of the revaluation, a difference might arise, and if the difference is arising, it means you will definitely record a deferred tax, because deferred tax is calculated on a temporary differences. So now what will be the adjustment for this one? Let's practice out this question, and then we will discuss the complication or the implementation of this one. Cyclone Company purchased some land on 1st January 2007 for $400,000 on 31st December 2008. That is after 2 years. The land devalued to 5 lakh. In the tax regime in the company operates, revaluation do not affect either tax base or the taxable profit. What does it mean? That tax department will not consider this revaluation. The income tax rate is 30%. Prepare the accounting entry and record the deferred tax in relation to the revaluation. Okay, first of all, we are going to recognize the deferred tax after 2 years. So are we going to calculate the depreciation? No, because we are dealing in asset that is land, and we know that land is never depreciated. So at 31st December 2002, 2008, property, plant and equipment, that is land, the carrying amount and the tax base. At the end of the year 2008, the carrying amount, that the value of asset as per accounting record is 500,000, that is as per revaluation model. But the tax base says we will not recognize this revaluation, and as per the tax base, it would be the 400,000. The tax base would be 400,000, as this will not recognize the revaluation. Now there's a difference. Yes, taxable temporary difference, carrying amount is greater than tax base. This is $100,000. That is taxable temporary difference, $100,000. And again, we'll apply the percentage on this taxable temporary difference, that is 30%, and will receive an amount of $30,000. But again, that is a deferred tax liability closing balance. I repeat, it's a closing balance. We need to recognize this as one for the current year. Let's calculate deferred tax liability. Opening balance is nil, closing balance is 30,000. So now the deferred tax for the year is 30,000. Now the important point is, in the previous question, we recognize is at a deferred tax expense. We recognize as a deferred tax expense, but now it will not be recognized as a deferred tax expense. What does it mean? IAS 12 states that if any deferred tax arises because of a revaluation, if any deferred tax arises because of a revaluation, it means it shall not be charged to P&L. It shall be charged to revaluation surplus. It shall be charged to revaluation surplus. What does it mean? Now the entry will not be prepared as deferred tax expense debit, but the entry will be prepared as revaluation surplus debit and deferred tax liability credit, that is 30,000. We will not recognize this deferred tax as an expense in P&L. Will recognize, will charge revaluation surplus. What does it mean? If you're making a P&L, you have an account, a component of OCI, and if you're having component of OCI, you have a revaluation surplus of 30, or you have a revaluation surplus of 1 lakh. You have a revaluation surplus of 1 lakh. Now you prepared the entry revaluation surplus debit deferred tax liability credit. It means you will reduce the amount of revaluation surplus by 30,000 and you will record the revaluation surplus by 70,000 and you will not debit the deferred tax expense. You will not hit the PLL. You will not hit the profit for the year. So always remember, any revaluation will definitely will definitely increase the deferred tax, but that deferred tax will not be charged to P&L, although the deferred tax will be charged to revaluation surplus. Okay, now we are having a question number 7. In question number 7, Hall Limited has the following balances, that is taxation credit balance. I told you in the earlier in a very start that whenever you have a taxation credit balance, it means it's representing the over provision. It representing the over provision. And deferred tax liability credit balance, that is deferred tax liability opening balance, is given in the question. Okay, taxation balance relates to the taxation balance, that is talking about this one. Taxation balance relates to an over provision 30th June 2013, and it is obvious whenever there's a credit balance, it means it's an over provision. We need to reduce the expense for the year. On 30th June 2014, director estimated the provision necessary for the taxation on the current year profit is 12 million. What is that? It is the current tax which is directly given in the question. That is the provision necessary for taxation. The provision necessary for taxation is $12 million, 12 million rupees. The balance on the deferred tax account needs to be increased to 23 million. It's not the deferred tax for the year. It's saying the deferred tax increased to 23 million. What is that? That is the closing balance for the deferred tax liability, which includes the impact of increase in the property valuation bill. During the year, Hall Limited revalued its property for the first time, resulting in a gain of revaluation. That is the revaluation surplus, 10 million. Now we need to calculate. The charge taxation will appear in the statement of profit and loss. It means if we sum up in income statement, if we are going to include the amount of income tax, we need to calculate the income tax by accounting for 3 types of taxes. That is, income tax will include 3 types of taxes. That is the current tax, the prior tax, and the deferred tax. Now let's calculate current tax, which is directly given in the question. That is 12 million. That is 12,000. Prior tax, that is the prior tax, 7,000 is the credit balance. It means an over provision. We need to reduce the tax for the current year. Prior tax, over provision, it means you have recognized the over expenses, but now you have to reduce your income tax for the year by 7,000. Now coming up to the deferred tax. Now, how to calculate the deferred tax? We need to identify the carrying amount and the tax base. So far, we are not provided with the carrying amount and the tax base. So, how to calculate the deferred tax liability? We have been provided with the opening balance of deferred tax liability, that is 16,000 credit balance. 16,000 credit balance. We have been provided with the closing balance as well. That is 23,000. That is 23 million is the deferred tax liability closing balance. Now, the difference would be the deferred tax expense for the year. No. There is a gain on revaluation during the year. It means 10 million. 10 million, that is 10,000 is the gain on revaluation. And definitely this closing balance has been calculated by in which the gain on revaluation deferred tax is already accounted for. So 10,000 and the tax rate is 30%. That is 3,000. What is that 3,000? That is the 3,000. That is the 3,000 deferred tax. That is the deferred tax on revaluation. That is the deferred tax on revaluation. And let's prepare the entry for this one. The entry would have been revaluation surplus debit, deferred tax liability credit. It means if we are going to post this entry in this, revaluation surplus will be debited, but the deferred tax liability will be credited with the value of 3,000. Now let's calculate the difference. Let's calculate the difference. 16,000 plus 3,000, that is 19,000 minus 23,000. It means 4,000. Now the 4,000 is the amount of deferred tax that will be reported in deferred tax expense. That will be reported in the deferred expense, that is the P&L. It means will not recognize the 7,000 as a deferred tax expense. I told you deferred tax expense will only be recognized in P&L is $4,000 because $3,000 is the deferred tax on revaluation surplus, and hence it will not be charged to P&L. So if we are preparing the income statement, deferred tax expense for the year will be recorded as 4,000 and not as 7,000. So the total income tax that will be reported is 12,000 plus 4,000 and minus 7,000. This will make 9,000 as income tax to be reported in P&L. So correct answer will be A, that is 9 million will be reported in P&L. I hope it's clear to you now. If there is any question so far, you may raise, please. Now moving on to the question number 9. Deductible company begins trading on 1st January 2017. In its first year, it makes a profit of $5 million. The depreciation charge is $1 million and the tax allowances on those assets amount to $1.5 million. Rate of tax is 30%. Calculate the current and the deferred tax. First of all, let's calculate the current tax. It is quite easy to calculate the current tax because to calculate the current tax, we need taxable profit. And for taxable profit, we need to work out. And the profit which is given is $5 million. And remember that profit is $5 million in which the accounting depreciation is already deducted. So we need to add back the accounting depreciation, that is 1,000,000, and we'll deduct the tax depreciation or the tax allowance, that is 1.5, that is 1,500. So let's calculate the taxable profit for the year. 5,000 plus 1,000 and minus 1,500. This will make 4,500. 4,500, that is known as what? Taxable profit. And simply we'll apply the percentage on this taxable profit with 30%. 4,500, 30%. This will make 1,350. That is known as what? Current tax. That is known as what? Current tax. It means the current tax for the year is 1,350. 1,350 is the current tax. But that is not the end. We need to calculate the deferred tax as well. We need to calculate the deferred tax. But for deferred tax, for the calculation of deferred tax, we need carrying amount and the tax base of an asset. But in this question, we have not yet been provided. We haven't been provided with the carrying amount and the tax base or the cost of asset. But let me give you an idea. But let me give you a tic-tac, a tool. Whenever there is a tax accelerated depreciation, whenever there is a tax accelerated depreciation. What does it mean, tax accelerated depreciation? It means tax laws are charging higher depreciation, and in accounting we are charging a lower depreciation. Always remember, when there is a tax accelerated depreciation, what does it mean? Tax laws are charging higher depreciation, while in accounting we are charging lower depreciation. There will always be a taxable temporary difference. There will always be a taxable temporary difference. And now in this question, accounting, in accounting we are charging a depreciation of 1 million, but the tax department is charging a depreciation of 1.5 million. So what is the difference? What is the amount of difference? In accounting we are charging 1 million and tax department is charging a 1.5 million. It means the difference is 0.5 million, and that difference is obviously the taxable temporary difference. You may solve this question by assuming the cost of an asset. For example, if I assume the cost of asset is 5 million, if I assume the cost of an asset is 5 million, so let's calculate the carrying amount of the tax base. Let's get this will the same answer will be reported. If I assume the cost of an asset is 5 million, so for accounting purposes, 5 million minus 1 million, the carrying amount would be 4 million, and tax base 5 million minus 1.5 million, the carrying amount would be 3.5 million. Tax base would be 3.5 million. So what will be the difference? What will be the difference? The difference would again be 0.5 million. So we have already calculated. You are not supposed to assume the cost of an asset. Don't try to drag it out. If you are having a difference in depreciation, just try to observe, just try to identify whether it is tax accelerated depreciation. If this is the case, so it means the difference will be the taxable temporary difference. The applied percentage on that difference, that is 30%, 0.5 million, that is obviously 5 lakh, and 30% is 150. 30% is 150. 30%, and again that is the deferred tax liability closing balance. Deferred tax liability closing balance. But so far we don't have any opening balances. We don't have any opening balances. So it means the current tax for the year is 1350, and deferred tax liability for the year is 150. Deferred tax liability is 150. It means the tax that will be reported, that is 1350 and 150. So the total tax to be reported in P&L would be 1350 plus, that is 1500 tax expense to be reported in P&L. So that would be the amount to be reported in P&L. Okay, now we are moving to the last question of this session, that is question number 10. And in this question, I've just taken this question from your past papers. That is a question of final account, and the question was Vernon Company. You may find it on your ACC portal as well. Vernon Company, the trial balance shows the tax amount in your trial balance with $130 with a debit balance. And I told you, if there is a debit balance of tax expense amount, tax is given with a debit balance, it means it's an under provision. It's an under provision. Now the tax figure in the trial balance represents the under provision and or over provision. If it is a debit balance, it means under provision. If it is was the credit balance, it means it might be it would have been considered as a over provision. The current tax liability for the current year, that is 31st December 2008, is estimated as 3.2 million. What is that? That is the current tax. And in exams, I told you, in exams, in 90% cases, you will be given with the current tax amount. You will not be supposed to calculate the taxable profit and to calculate the current tax amount. No, in exams, 90% cases, you will be given with the current tax amount. Okay, prior period is given, current tax is given. Now the main part is, that is deferred tax. During the year, Vernon revalued its head office for the year for the first time, resulting an increase in $12 million. It means there is a revaluation of $12 million, revaluation surplus. Deferred tax is applicable to this gain is $12 million. Deferred tax is calculated to this gain on 12 million or 25 million, sorry, 25%. Now what you have to do, calculate the amount of tax to be reported in profit and loss account. Profit and loss account. Your one company trial balance shows tax debit balance, and this means that that is an over provision, and tax figure in the trial balance represent the over, that is over or under provision, and we identified that if it is the debit balance, it means it's an under provision. Okay. The current tax liability for the year is 3.2 million. And one more important thing is, during the year, one non-revalued its head office for the first time, resulting in increase is 12 million. That is the revaluation surplus. And deferred tax rate is, or the current tax rate is 25%. We need to calculate the amount of tax to be reported in P&L. So how we going to calculate the amount to be reported in P&L? That is income tax. We know that in income tax we have three different types of taxes. Number one, the current tax, the prior tax, and the deferred tax. Current tax. Now, what is the current tax? The current tax, which is already given in the question, that is 3.2 million. That is 3,200. Let's say 3,200. And prior tax, we have already been provided with the prior tax, that is 130, and that is under provision. It means we need to increase the amount of tax, that is 130. 130, it means we'll increase the amount of tax by 130. If it would have been a credit balance, it means definitely we must have reduced the amount of tax, but now we'll increase the amount of tax by 130. Now, what about the deferred tax? Let's calculate the deferred tax. And for deferred tax, we don't have any opening balance. We don't have any opening balance. We don't have any closing balance. But once the point is given over there, that is, there is a gain or revaluation of $12 million, $12 million. And we know that earlier in this slides, we identified that if we are having a gain or revaluation of $12,000, we will calculate the deferred tax on that revaluation. That is 12,000 and 25%. That is, it will make 3,000, and that $3,000 will not be recognized as a deferred tax expense. Instead, it shall be recognized as revaluation surplus debit and deferred tax liability credit. That means 3,000 will be recorded in or will be adjusted in the revaluation surplus account and not to the P&L account. It means if there is no deferred tax liability opening balance, no deferred tax liability opening balance, neither the closing balance. It means the deferred tax liability, which is recorded exclusively for the revaluation surplus. It means there is no other temporary differences. So revaluation surplus debit and deferred tax liability credit 3,000. So the closing balance of the deferred tax liability account would be 3,000, and it will be recorded in the balance sheet. This will be recorded in OCI. It will be adjusted in the amount of revaluation surplus. So no deferred tax expense will be recorded here. That is 3,200 plus 130. It means 3,330 will be recorded as a deferred tax for the year. Will be recorded as a deferred tax, or sorry, the income tax for the year. PT stands for prior tax, prior period tax. Prior period tax, we have already discussed these terms. CT, that is the current tax. PT, that is a prior period tax. DT, that is a deferred tax. And a prior period tax was already given in the question. If you just look at the question, the tax balance was 130 debit balance. If it is the debit balance, it means it's an under provision. Ikra, I think you have joined it right now, but we were having a session, and this session was started at 11 a.m. Recordings will inshallah be provided to you. Don't worry about it. Recordings will be provided for this session, and you may definitely refer that recording. We have discussed in quite detail, what is prior tax, what is current tax, and what is a deferred tax. So this was the treatment, and this was the session in which we discussed regarding the current tax, the deferred tax, and the prior tax. And we also discussed how the examiner will definitely ask you a question regarding this standard, that is IS 12, how the MCQs can be tested. And in the last question, we saw that how the examiner will test this standard in a final account question will definitely give you an adjustment, and you need to calculate the income tax in order to calculate, or in order to prepare your income statement, because income tax is the important line item of your statement of profit and loss account, and you must know that how to calculate that income tax. So this was from the session, and I would like to thank you all for joining this session. Inshallah, recordings will be provided to you, and you may definitely refer that recording for your help and for your support if you feel, and if you want to discuss anything, or you want to discuss any query, any question relating to F7 financial reporting, you may definitely contact. The contact number is on your screen, and inshallah I will try to help you out in your concerns, in your queries. Thank you so much for joining this session. One more thing before we leave for the session. I would like to wait a minute. Okay.